Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a senior manager and education coach here at Schwab, and this is managing an options portfolio. And it is Fed decision day. We're going to see what happens in just a couple of hours. But I thought, hey, let's talk about a strategy that some traders might employ around just this sort of an event. When there's a big unknown that's looming right over the horizon, what sort of option strategies might traders employ in their efforts to take advantage of that uncertainty? So we're going to be doing something known as a double calendar. Should be an interesting discussion. If you're not familiar with this strategy, I'll try to go at a pace that everybody can follow. But before we can get to any of that, let me first of all say hello to everybody who's already chatting in out there in YouTube. Hello there, Will and AJ, David, Eva, Josh, Life in the Fast Lane. Who else is here? Ricebird, everybody else. Thanks for joining us week after week. I really appreciate your attendance and your contributions to these discussions. If you are here for the very first time, though, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, if you're just watching the recording of this presentation, enjoy the show, but be aware that you're invited to join us in the live discussion. This is a Wednesday webcast series. It kicks off at noon Eastern. We'd love to have you here in the live stream. I also want to let you know that my very good friend Brent Moore is going to be hanging out in the chats with us. He's going to be answering any questions that I can't get to just during the flow of the presentation. Thanks for having my back there, Brent. And Brent and I would like to issue an invitation to everybody watching, whether you're watching the live stream or you're watching the archive. If you're not following us on X, please do that. It's a fabulous resource to connect with your favorite presenters in between the live streams. So you can find Brent there on X at Brent Moore CS. You can find me there at Cameron May CS. But let's get into this. First thing that we're going to do, of course, is consider the risks associated with investing. This is important information, so bear these disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, investment strategy. Investing involves risks, including a loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. So with that said, let's set the agenda for the day. 3 items on the agenda as we have each week. In this webcast series, we have built and manage an example paper money portfolio consisting of options trades. So the first thing that we're going to do is look at the existing positions within that portfolio, see if any of them need some specific attention today. And I'll tell you, I think there are a couple that we need to deal with today. Then we're going to look at current market conditions, including the fact that we have this big unknown. I don't know how terribly unknown it is, but we'll talk about that. But the Fed rate decision is going to be announced in just a couple of hours. So what we're going to do as we look at the markets is keep that in the back of our minds and structure an example strategy that sometimes traders will turn to when they think a stock or a market might go up or it might go down, and they want to structure a trade that could benefit in either direction, as long as the move isn't too severe. So that's going to be our discussion of a double calendar. And we're going to look at an example of a double calendar and add it to the paper money portfolio using the Thinkorswim desktop platform. So let's go right to Thinkorswim. And here's our existing positions. We're going to look at all of them individually. So starting with Amazon. On Amazon, we have what's known as a bullish call spread, a long call vertical, bought the 205 calls, sold the 210s. With this trade, the trader would prefer that the stock be above 210 as we get toward that 20th of December expiration, which is now just 2 days away. And you can see, not only are we above 210, we're $20 above 210. So well into the area where we'd like to be on this trade. We've closed out some of this position as it's been going and taken some profits already. But you can see here we are up at about 230. We're going to leave this on, let it go to expiration. Not going to do anything with it. Now with a long call vertical, what the trader is hoping for is assignment. Well, exercise the long, get assignment on the short, and that helps them achieve their theoretical maximum gain. Now, even though we're well up into profit range right now, that doesn't mean in the next 2 days there couldn't be something devastating that happens and causes Amazon to collapse and fall down into our spread or even below it. It could surrender all those gains. There's that risk. Now, I'm going to leave this trade on just to see if we can maybe we only have one contract on either side. That one contract's worth of exposure at this point anyway. Started with 10, whittled it down to 1. But right now, we're essentially at that maximum theoretical gain. You can see on a $5 wide spread, best we could theoretically do is see this grow to a $5 difference between the two strikes, and that's right where we are. AJ said, you've never heard of a double calendar. This should be fun. I think it will be. All right. So Amazon, we're going to leave that alone. CRM with Salesforce, we're not going to do anything with this one either. This is just a straight old long call. We own the 270 call for the 21st of March. That still has 93 days till expiration, and it's been doing quite well. If we look at the chart here, obviously with a long call, the trader has a preference for stock prices to go up. We entered this long call down here, selling short calls along the way. But you'll notice a technician might look at this chart and think, hey, we popped up, hit resistance here around 347-ish, broke through that, and that looks like that's acting as a new support. Let's say that our trader here thinks that that support's going to hold, and if the stock takes off again, could be in for another run here for the long call. So we're going to leave that one alone. Next up, we have Google. We have Alphabet here, which is another long call spread, 165, 182.5. We'd like to be above 182.5, and we're at 195, almost 196. So if you want to see that on a chart, here's what that looks like. The trader would really like to be above this 182.5 as we hit this December 20th expiration. And you can see that we're solidly above that. I'm going to let that one work. Again, just one contract's worth of exposure here to the upside or to the downside. There's always the possibility of a severe reversal in those last 48 hours, so we have to be aware of that. Microsoft is going to be the first one that we do a little bit with. We're not going to do just a little bit. We're going to close this thing out. With this, we have what's known as a condor. So we used all calls. It's similar to an iron condor. It has a similar bias, but instead of using calls and puts to construct the trade, we did just calls. Did a bull call spread and a bear call spread at the same time, with the preference to be between the two short strikes, 410 and 440. We're not between the two short strikes. We're at 452 right now. We've actually gone all the way above this. All of these contracts are in the money, all looking to be signed and exercised. We're looking at maximum theoretical loss on this trade. So pop back here. So with the Microsoft position, look at that on a chart. See, we'd prefer to be down in this range. What happened is we popped up above our upper strikes, and we have just stubbornly remained there. Even earlier today, it looked like, oh, maybe we'll get a reversal. We came down right down to our upper strike. Nope. Getting kind of a hammer pattern there. Popping back up above. With this one, we're just going to close it out. Sometimes you got to admit defeat. Could we leave this in place? Let it go to expiration? Yes. Obviously, there are risks in each decision we make, as well as potential rewards. If we leave this alone, is it possible within the next 48 hours that we could slip right back down below 440, and all of a sudden we find ourselves in maximum gain territory again? That's a possibility. But what if we didn't slip below 440? What if we just slipped below 445? Ooh, in that case, here's a risk. The long call there it would just expire worthless unless we decided to do something with it. The short call at the 440 strike would be assigned, with very rare exceptions. Some trader would require us to sell shares to them at $440, and we don't own shares in this portfolio, and we could wind up short stock. That would be a substantial risk. Could completely change the reward risk profile of this trade come Monday. So let's close this one out. I'm going to right click on this. Let's create a closing order and just sell this condor, sell out of it. Looks like we might be able to can we pull 37 cents out of this? Probably not. No, very, very unlikely. In any case, let's see if we can maybe, where do we want to go with this? Let's set it closer to halfway between the natural and mid. I might even push it toward the natural a little bit. Let's see if we can get a fill. Let's click confirm and send. Selling out of these condors. This is going to give us a max gain. Oh, look at this. Always a loss. Yeah, it's because we're closing it out at a loss. Anyway, there is a commission to be considered here. And let's send this order. When you see an always a loss and these max profit, max loss scenarios on closing trades, it's looking at it as though it's a brand new opening position, and it's not. So we don't worry about that. I'm just going to send this order off. I'm going to let that work and move on to NVIDIA, which is another bull call spread with this 2 days left on the contract. Looks like we're out of that condor there. But we'd like to be above 135, and we are just barely above 135. Now, this is a it is now a profitable trade. Look at this. We are eking out a $16 profit at this moment, thanks largely to what's happened today. Seeing an unrealized profit from today. That's an improvement on a loss that we had up to today. Just getting us up to about a break-even level. Only 2 days left. This thing could go up. It could go down. We're not going to be here to talk about it going forward. So I think we're going to close this one out. And with NVIDIA, yeah, I think so. But let me just show you this on a chart. So there is where we are. Look at that. Just at that upper strike. We'd like to be up here. We'd be feeling more comfortable if we were up here. We're just dancing right on the precipice. If we were to slip down between the strikes, that could result, if we go back here to our position, you can see if we slip down below that 135 call, it's quite possible that just expires unassigned. But our long call, unless we left a do not exercise set of instructions, that's just going to be exercised. And we might wind up buying 1,100 shares of NVIDIA at $130 a share. So the trader needs to be keenly aware of risks and obligations, rights and obligations as they approach expiration. So with this one, with it right there, and we're not going to have the luxury of reconvening to talk this through again before we hit expiration, I'm just going to close it out. And it looks like it's going to be pretty close to break even. Maybe we can squeak out a little bit of a profit here. But let's right click. Let's create a closing order and sell that vertical. And this is just, well, actually, no, I was going to say something. I want to backpedal from that. Anyway, 343 credit, maybe down to 338. Let's say that we're willing to settle for somewhere in the middle, maybe a 345 credit to close these out. Anytime we submit limit orders on these trades, there's always a risk the order might not fill. Ooh, looks like 345 might be out of the realm of possibility at the moment. You can see prices moving around quite a bit. And that's not uncommon. But let's click confirm and send. Selling that vertical, we're going to try to pull $3.44 out of it. There is a commission to be paid, multiple contracts, multiple strikes. Let's send this off and see if we can exit. It's going to be pretty close to a break even. We'll let that work for just a moment. There it is, sitting up there. Looks like we're asking for a 344 credit. 342 is the current mark or the market price. So it's close. We'll see if we can get a fill. In any case, last position in the portfolio is this Walmart combination trade that was proposed by somebody in the YouTube comments. So we talked about last week, is it possible for a trader to just make up their own strategy, even if it doesn't have a name like an iron condor or a vertical spread or a diagonal spread? Yeah, it's possible, as long as they understand the rights and the obligations, the risk and reward profile of the trade. If they like the scenario that they've created, they can go ahead with that. But with this, we bought a 90 call, bought 90 calls, sold the 95 calls, bought the 100 calls. We created essentially just a bullish combo trade. The 90-95, we might look at this as just a long call vertical. And then we tagged on an out of the money call option for 5 of those. So that's 2 bullish strategies. We're just bullish on this trade. We'd like to see Walmart go up and up and up. and it's kind of been going up a little bit. Let's go have a look at it on the chart. You can see last week we placed a trade here. We're up a little bit, but we'd like to just go up higher and higher and higher. That assists the long call vertical with being in its maximum theoretical position. That would be a maximum theoretical gain position. That would be anything above $95. But the further we go, looks like we're out of that vertical for 344. Okay. But the further we go above 95, the more it can potentially help that 100 strike set of contracts that we have. So we'll let those continue to work. But with that, we've taken a look at managing our existing positions. We still have a number of positions left to roll forward with into the future, but I wanted to add a new position to the portfolio today. Now, as a trader does that, the first thing they might want to do if they're thinking of building out an options portfolio is maybe decide, well, what kind of trade might be appropriate for today's market conditions. If the trader's conviction is that the markets are very bullish, maybe they want to add more bullish trades to the portfolio. If they're turning a little bit more bearish when they've previously been bullish and they're adding new positions, maybe they consider a new bullish trade. But let's look at what's going on with the S&P 500. It's been a great run. We've talked about this over and over again. The S&P's just been going up and up and up with comparatively smaller departures to the downside over comparatively shorter periods of time. But here we find ourselves trading right close to all-time highs on the S&P, but not accomplishing a whole lot over the last 2 weeks. Could an argument maybe be made that traders have been a little bit reticent to take large positions in advance of a potentially important decision like we have coming from a Fed in just a couple of hours? That's a possible contributing factor to this consolidation. And it might just be a quiet period while a lot of traders are hitting the holidays. Yeah. Carol says, can we take a look at the FOMC rate decision? So I'm sorry. Now the decision, Carol, you're saying is it's reporting right now? It shouldn't be. That should be in a couple of hours at 2 o'clock Eastern time. It's only noon Eastern time right now. Bear with me for just a moment. I'm just taking a quick look. I don't see anything. That would be a surprise to me. Anyway, yeah, it should be in a couple of hours. Anyway, but it could be that prices have just been going sideways for reasons, including hesitation to take big positions in advance of the Fed announcement. So a trader might just decide to sit there and wait and see what happens. But let's put ourselves in the shoes of an options trader who wants to trade specifically in advance of a big announcement. Could be a Fed announcement, could be something like an earnings announcement on an individual stock. But what kinds of strategies might those traders go for if they don't know exactly how the announcement, whatever it is going to play out, or how the reaction to the announcement is going to play out? So with this Fed announcement, you can use something like the CME Fed rate tool that gives an estimate of the likelihood of specific moves by the Fed, and it's looking like a very high probability that the Fed is going to cut rates by 25 basis points in a couple of hours. But just because we have a high probability that we know what's going to happen, does that mean we have a high probability that we know how the market is going to react to what's going to happen? Not necessarily. And from here, stocks may react positively or negatively to whatever that announcement turns out to be. So our trader may not want to take a position that is purely directional, where they're essentially deciding that the market is going to be positive or it's going to be negative. Let's just suppose they expect a move. They just don't know which direction. Well, if we were bullish, we could put on a bullish trade. If we were bearish, we could put on a bearish trade. Well, sometimes traders will put on one of each. And a strategy that's sometimes done in advance of this sort of an announcement is known as a double calendar. It's not the only strategy. I'm not giving you a sales pitch that everybody should be doing double calendars in advance of big earnings or big announcements like earnings or Fed rate announcements. But let's just suppose that our trader is thinking of doing that today. So what kind of stock might they do it on? Well, for some traders, when trading options for any reason, they may put an emphasis on liquidity. Illiquid stocks tend to have illiquid options, and they can have pricing issues that make them even more difficult to trade profitably. So liquidity, lots of trading volume could be one consideration. Another consideration might be price per share. Higher priced options tend to have more options to choose from, but they also come with bigger obligations for 100 shares, bigger potential risks. So there are pros and cons, but also with something like a Fed rate announcement coming up, there are some sectors that historically have tended to be more sensitive to those. And if the trader is banking on that sensitivity, well, maybe they look in a specific sector. One of those sectors, not every sector behaves in an extremely predictable way around every Fed rate change. But one of those sectors that tends to be a little bit more sensitive to rate changes than others is the finance sector. So let's suppose that our trader is looking at something like Wells Fargo. But here's what's been going on technically with Wells Fargo recently. Price has been making jumps up and down, and you can see it's been primarily upward. Recently, though, kind of stair-stepping back down to a support level, potentially around that $70 level. Let me switch up my drawing tool here. Let's go with the price level drawing tool. It's just going to draw a nice horizontal line for us. And I'm going to position that right at $70. And I'm going to carry that right on out. Let's plan a trade that at least goes through that January expiration. Right? Oh, and by the way, as I'm going to hit the pause button on this for just a moment, because there's just been a link that's been added to the chat window for the live stream audience. It's for, actually, never mind. It went away. Hold on a second. Let me just double check. Yeah, okay, never mind. Maybe there was going to be that, and now it's not. Okay, so ignore what I was saying. Back to our chart. So with Wells Fargo looking like it was bullish, now maybe looking a little bit bearish, but we're sitting at a support level. Could a trader suspect that maybe we're about to bounce and head higher, possibly on the strength of a Fed announcement? That's possible. Could it also be that traders leading up to this Fed announcement have other concerns about Wells Fargo, and they're already pricing in a Fed cut, and who cares? Maybe this recent bearish bias is going to continue and we'd move lower. That's a possibility. So we could go up, could go down. Let's structure a trade that might benefit if it goes up or if it goes down. Now, it actually carries the possibility for failure, so we have to be aware of that. But I'm going to structure a double calendar spread, and I'm going to do it up here at $75 and down here at $65. So if this is your first exposure to double calendar, I think somebody said this is going to be fun. I think so. Yeah. So, there's the survey. Okay, now I can say it officially. So for those that are in the live stream, there's been a survey link added to the chat window. If you do me this favor, click on the survey link right now, and that'll give you the opportunity to fill it out after the webcast is over, and you can give me some honest feedback. I just want to tell you, if you've never filled out one of our surveys before, they're very short, 2 multiple choice questions and a comments box and a suggestion box. And if you take the time to fill out that survey, I'll take the time to read through the comments, and I sift through that data, and it definitely helps. So it's never a wasted effort. Definitely appreciate it. Okay, so now back to our example trade. Now, a double calendar sort of begins life. I'm going to tell a story. This is the way that I think about a double calendar. It's not the way that everybody thinks about it. But it sort of begins life with a trader who doesn't know which way the stock is going to go. So maybe they're just going to buy a call and they're going to buy a put and duke it out. If the stock goes up, great. Their call could make a lot of money while their put kind of gets squeezed. If the stock goes down, their put could make a lot of money while the call gets squeezed. So here's our example trade. This is going to be our double calendar. Go to the trade tab, and I'm going to go out here a little bit beyond the 17th of January. We're going to come back to that expiration in just a moment. But if we think, let's say the stock is about to go up to $75, and maybe it takes all the way through the 17th of January to do it, well, buying a $75 contract up there with a call, that thing would just expire at the money. That wouldn't have any value for the trader. So let's go out beyond that to the 21st of February. And we're going to buy $75 call. I'll put in the date here, reference. 21st of February, $75 call, not cash call. And it looks like that's trading for, around 206, 209. We'll call it, 208. Say it costs us 208. And at the same time, they're going to buy at 21st of February, $65. Is that what I said on our chart? Yep, that's what I was going to do. So we're going to buy the $65 put. And it looks like it's trading between 126 and 129. We'll call it 127. Now, that would actually just be known as a strangle. There is such a thing as a trade that looks just like this. One of the difficulties of a strangle is that it's taking two types of contracts, both of which have time working against them. So it turns a low probability scenario into a lower probability scenario potentially, or at the very least, it increases the risk of the trade. But to turn this into what we call a double calendar, the trader just goes to a shorter term time frame. And this is where we're going to go back here to the 17th of January. And we are going to sell same type of contracts at the same at the same strikes, but at a shorter term expiration. So we're going to sell, in this case, the 17th of January, $75 call again. And how much is that trading for? About $1.18, $1.19. We'll call it $1.18. And we're going to go to the put side and sell the 17th of January, $65 put. Let's see how much we can get for that. Between 57, 59, let's call it 57 cents. So what is the trader doing here? Let's talk through the motivations of this trade for just a moment. Well, what they're setting up here is a trade that can actually benefit if the stock either goes up to, I'm gonna sort of map this out. Let's get our drawing tool, switch this to our trend line tool, and I'm going to target the 17th of January. So we're talking about where would we like this to be as we get toward that first expiration. Josh Pink says, seems like a lot to manage. Maybe not, Josh. Yeah. But what we'd like to see from here is for the stock either to go up toward 75 or down toward 65 as we get toward that 17th of January expiration. Now, let's talk about why that's the case and how this trade can fail. And I'd really like to put this trade in. We're going to look at it on the Analyze tab so we can see its profit and loss scenarios using that tool. But why do we care about where this stock, why do we want this to go up or down? Well, the trader, anytime we start to get fancy and we start to layer on different contracts, just keep in mind, as complicated as options trades can start to feel, there are really only two types of options. There are calls and puts. And there are only two things we can do with them, buy them or sell them. So as long as we understand the rights and the obligations assigned with associated with buying and selling puts and calls, then the trader can really just break down any strategy that they can conceive of. So let's talk through, let's say we get into this trade right now and the stock goes right up to just below 75 bucks as we hit that January 17th expiration. Mike says, is Brent really tall? Had no idea Cam is tall. Yeah. Brent's like, how tall are you, Brent? 6'3", something like that, 6'4"? a little bit under 6.7. I still claim 6.7. I'm not quite there anymore, but I'm still going to say that I am. Anyway, yeah, let's take this scenario where the stock goes up to 75. And as a matter of fact, let's just say it's at 74.99, just to use kind of an extreme example. If the stock goes up to 74.99, what does that do for this long call we own? Hey, the stock going up is beneficial for a long call, right? Long call is great. At the same time, beneficial for this short put that we sold. So both of those trades, that's just what we want to see happening. Long call is gaining value. Short put is losing value. Perfect. What about this short call? Well, it expires on the 17th of January. And if our stock is at $74.99 and someone else has the right to buy shares from us at $75, that right has no value to them. They could still sign the contract if they wanted to. But really, this contract is in position to just expire worthless. So long call is doing well. Short put is doing well. Short call is doing well. So our short call and our short put have basically hit expiration. They're both out of the money. They expire worthless. So 3 for 4 so far. What's the one fly in the ointment here? Well, this put that we bought is also shrinking in value. So, but if the stock is going up, we have 3 out of our 4 contracts working in our favor, as long as we haven't gone above $75, where the short call is actually still retaining some value. So you can see why we have this bias. If this goes up to $75, that's pretty good. Well, another thing that could happen, what if we went down to 65? We need to reverse all of this thinking. Well, if the stock is going down, is that helping or harming this put that we own? Hey, it's helping that out. Could be increasing the value of that put. So that's 1 for 1. What about the call that we sold? That's also a bearish strategy. As we're going down, that call is getting further and further out of the money, and then it hits expiration at the 17th of January. It expires worthless. Hey, 2 for 2. Great. What about this put that we sold? Well, someone has the right to put shares to us for 65. Let's say the stock has come down, and it's down at 65.01 as we hit the 17th of January. That trader who bought our put has the right to sell shares to us for 65. That's less than those shares are worth. That's no value to that trader. Could they still assign the contract for whatever reason they have in mind? It's possible. It's not likely. Okay. But yeah, that's 3 for 3, theoretically. What is the one holdover? Right up here, this call that we bought. Stock going down in price is not beneficial to a long call. So if the stock goes down toward our 65 strike, that's a potential 3 for 3 win scenario. If it goes up to our 75 strike, that's a potential 3 for 3 win scenario. Even if it hangs out in the middle, we might still be okay on this trade. Where can this trade really start to break down? Well, if it starts to go too far above 75 or below 65, our short options start to do some damage that can offset the gains of the other contracts. So here's what this looks like. Now, oh, and by the way, I was going to explain, why is this called a calendar trade? Well, it's because with both the calls and the puts, the only difference between the options that we're trading here are the dates involved here. It's the same strike. It's the same type of option, only separated by literally the calendar. So these are known as calendar spreads. And this is a double calendar spread because we have 2 of them. We have a call calendar and a put calendar. So let's look at this. Let's enter this trade and look at it on the Analyze tab. Let's go to our Trade tab. And there are a number of different ways we could put in this calendar. We could actually come up here and change our spread to double calendar. But another way is to just hold down the control key on the keyboard and start clicking. So while we're here on the 17th of January, it doesn't matter whether we put on the short options or long options into the order first. But let's just do this. While we're here on the 17th of January, these are the contracts that we wanted to sell. So let's go to the puts, click on the bid price for those puts. Now, let's go to the calls and hold down the control key on our keyboard and click on the call that we intended to sell. So you'll notice as you hold down the control key, that just starts to stack up these orders down there in the order entry tools field. So I'm going to click this down arrow again, that just sort of minimizes that order screen, gets it out of the way. And now we can move out here to the 21st of February and buy the long contracts. So going again to the puts, let's hold down the control key. So it's adding this to the two short options. Let's click on the ask price to buy those puts. We're going to go to the calls, the 75, hold down the control key and click on the ask price to buy those calls. So now you'll notice there is a debit that is being paid here. So there is certainly loss potential on this trade. When we pay for a trade, we can lose up to the debit. But let's look at all of this on the risk profile. So let me just double check something here. Yeah, let's pop up here to the risk profile, make sure I don't have any stuff hanging out there already. And I don't. So I'm going to right click on this order before I submit it. Just right click on it. And then we can analyze this trade. And when we choose this, what this does is it takes us to the risk profile page, and it maps out here for us a profit or loss chart at expiration, just according to the strike prices that we've chosen. So Eva says, is this similar to a double diagonal, or am I confused? Eva, it's similar, but it's not exactly the same. Yeah. So a double diagonal, we buy some longer term, we buy a longer term call and put, just like we've done here. But instead of doing the same strike, most commonly the trader will go a little further out of the money and sell the short options at a further out of the money strike. And what that does, it actually changes the potential of the trade fairly significantly. Yeah, it can say double diagonal. Right here, you're saying it says double diagonal down there. That's okay. Double diagonal, double calendar. I know that they're different trades, but similar enough that the system, the label that's applied when you put in the strikes individually, like I did, it gives it that double diagonal label. So I can see why you're confused. It's still a double calendar. We don't worry about that. Okay. But in any case, a couple of modifications that we might want to make to this tool as we start to map out this trade. Number one is, since we have the short options expiring on the 17th of January, let's go up here and I want to set my probability range, this gray field up here, to the 17th, or just beyond the 17th of January. Let's go to the 18th. And that just shows us this gray area dated for the 18th of January, just after the short contracts expire. Now, another thing that we might want to do is come to the actions menu down here and set our slices, these lines, these vertical lines. Let's set those at break even for, and I think they already are, the 18th of January. Yep. What that does is it just shows us, hey, Cameron, come the 18th of January, your trade is structured to break even here or break even here. So now let's get acquainted with this tool. If you're not terribly familiar with it, this gold line, I'm going to ignore the blue line for now, but the gold line is showing us how this trade is likely to perform at expiration if the stock price moves to specific levels. Okay. Right now, we know the stock was trading, what was it, around $71? It's right there. There's a little hash mark there indicating where the current price is. But if the stock goes up from 71 to 72 to 73 to 74, we can visually reference how our trade is doing. And over here to the left is a breakdown of potential profit or loss with break even at the 0 line. So what do you notice with this trade? As long as we're between about $63 and about 78.5, at expiration. That is for the short contracts. There should be some amount of profit. AJ says, why are the peaks at different levels? AJ, that's because the stock is already a little bit closer to 75 than it is to 65. And so the call and the put costs were a little bit different, tilted the scale a bit. That's what's going on there. Okay. But yeah, if it just so happened to be that when we were structuring this, the stock price happened to be right at $70, you'd see these peaks be pretty much identical. But in any case, let's run through some hypothetical scenarios. Let's say the stock runs up to $75 and we wind up just at or below $75. Well, then we already know the probable outcome there. Our two short contracts expire worthless. Cha-ching. Our long call has gained value, and the combination of those facts has overwhelmed the loss that we take on the short put, on the long put, and we hit a nice peak in potential profit there. Now, what's the likelihood that we hit exactly $75 at expiration? That is a point on a chart. It's not terribly likely. Much more likely we wind up somewhere else. But I do want us to be aware of where the trade might do best and where it might start to falter. If we fall down to 65, we've already walked through the logic of that. We're talking about probabilities and theoreticals until this actually happens at expiration. But yeah, if we wind up at 65, still pretty good. That's the second place we'd like to be. Isaiah said, what happens when you get a sign on either side? Well, we just need to be aware. With long and short options, we need to be aware of our rights and obligations at expiration. If we happen to if shares get called from us, we could wind up in a short stock position. If shares get put to us, we could wind up in a long stock position, and then deal with whatever happens with stock price after that. Yeah, but a little bit too much for me to revisit in the remaining time today. But this trade starts to break down if there is an explosive move and we go either below 63 or above 78.5 at expiration. And you might not think that's very likely, but with the Fed announcement, plus there's an earnings announcement on Wells Fargo before the 17th of January, that's still a possibility. But I can say there's about a 68% chance that we just wind up between these two break-even points. That's what this means. About a 17% chance we wind up above, 16% chance we wind up below. And we wind up in loss territory to some extent. All right, but let's go place this trade, our double calendar. Let's just click confirm and send. Let's dial this up a little bit. I'm going to do a few more contracts here. Let's do 5 contracts, multiplying the reward potential, multiplying the risk potential. Let's click confirm and send. Buying 5, they're actually double calendars. I know it's calling it a diagonal, but these are calendars. Of the 21st of February, the 75, 65, 75, 65 combination. Cost of the trade is going to be about $800, and we're really just hoping to go toward 75 or toward 65. Yeah, Isaiah says absolutely. Yeah, you could see if you get assigned on let's say a short position. Yeah, well, you could a short stock position. There is unlimited loss potential in that trade. Let me send that off, and we're going to let this trade work. Let's see if we can get a fill. Might not. Let's double check that. 158 debit, 156 is what it looks like. It should be that. I mean, I feel like we are likely to get filled. I'll let it work, but guys, we've hit the edge of our time. We'll see if we can go to 75 or go to 65 as we get closer to expiration. Those would be the optimal outcomes. Going too far beyond those extremes is where the trade starts to break down. But we've wrapped it up for this webcast. We've also wrapped up this series for me as your presenter. I'm turning over the reins to Brent for 2025. So yeah, there are changes coming in 2025 to our webcasts. Make sure to go to schwab.com/coaching/webcast to see those changes. You can just push the calendar forward to January and then look at I just heard it in my ear. Our trade just filled. Anyway, Managing an options portfolio has Brent's profile there. I'm going to move to, we have our getting started with Thinkorswim that I'll be doing on Wednesdays. Okay. Also, make sure, everybody, that you're subscribed to our YouTube channel. This is the best place to come and find our previously delivered webcasts organized into playlists. You can also join our live streams. Just go down and click on the subscribe button. It only takes a second. It doesn't cost anything, and you're subscribed. And also make sure that you're following Brent and me on X. You can find Brent there at Brent Moore CS. You can find me on X at Cameron May CS. But it really is the very best place to find your favorite presenters in between the live streams. Everybody, thanks for those of you who already filled out the survey. Fabulous. Click that survey link now if you're in the live stream. You can give me some honest feedback. And thanks to everybody who's already clicked the like button. We always get pretty good participation here. 150 people watching the live stream. About a third of whom, 45 people, have already clicked that like button. Thank you for doing that. If you just be in the habit of always clicking the like button when you like one of our webcasts, it's a nice pat on the back of the presenter. But also it gives my webcast a boost in the YouTube algorithm and helps it find a wider audience. All right, everybody. Thanks for watching. I will see you. Yeah, we're dark for this webcast and the rest next week because it's Christmas next week. And then also dark the following week. And we'll be back after the new year with Brent as your presenter. Thanks, Brent, for helping out in the chats. Everybody, have a great day. I'll see you in my webcast on Friday. If I don't, wish you happy holidays. And whenever I see you again, until that moment arrives, I want to wish the very best of luck. Happy trading. Bye-bye.